If you thought 2026 would start like any normal year, think again. In the first 48 hours of January, the precious metals market witnessed the largest physical silver raid in 46 years. We're talking about 17.2 million ounces of silver, or roughly 2% of annual global production, vanishing from COMEX registered vaults in a single session. But here's the kicker. This wasn't a retail squeeze. This was a bank-on-bank war, where Deutsche Bank lost 3 million ounces to JP Morgan, who grabbed 80% of total deliveries. Meanwhile, retail American silver eagles are disappearing from dealer shelves, and physical silver is trading at $130 per ounce in Japan, while paper markets show $71. Today, I'm going to break down exactly what's happening, why China's January 1st export restrictions are weaponizing silver, and what this means for your investments in 2026. Stay with me until the end, because what's unfolding right now could reshape the entire precious metals market for decades. Let's dive in. Let's start with what happened on January 2nd and 3rd, 2026. COMEX, the world's largest silver futures exchange, experienced something unprecedented. In just 48 hours, the 17.2 million ounces of silver stood for physical delivery. To put that in perspective, that's approximately 535 metric tons of silver demanding immediate physical settlement. Now, here's where it gets interesting. This wasn't driven by small retail investors or the Reddit Wall Street silver crowd. This was institutional, big banks cannibalizing each other's positions. According to forensic analysis of COMEX data, Deutsche Bank was forced to deliver approximately 3 million ounces of physical silver, and JP Morgan Chase grabbed roughly 80% of all deliveries during this period. Think about that for a moment. JP Morgan, which has been accumulating silver for over a decade, just positioned itself to control an even larger share of physical inventory, right as global supply is tightening. This is the same bank that paid $920 million in fines back in 2020 for precious metals market manipulation. Now they're legally vacuuming up physical metal while other banks scramble. The COMEX registered silver inventory, metal that is available for immediate delivery, has been declining sharply since 2020. In December 2025 alone, over 60% of registered inventory, approximately 47.6 million ounces, was drained from the exchange. We're now looking at some of the lowest registered inventory levels in years, and this is happening just as demand is exploding. What makes this even more critical is the timing. This massive delivery demand came right after China implemented its silver export restrictions on January 1st, 2026. The market is essentially pricing in a structural shortage, and the big players are moving to secure physical metal before the supply crunch intensifies. Now let's talk about the elephant in the room. China's export restrictions that took effect January 1st, 2026. This is being called China's silver weapon, and for good reason. China doesn't just produce some silver, they produce 60 to 70% of global refined silver output. That's total market dominance. And starting this year, China has implemented an export licensing regime that fundamentally changes the game. Here's how it works. Only 44 approved companies can now export silver from China, and they need government licenses for every shipment. To even qualify for approval, companies must have annual production capacity of at least 80 tons, and verified credit facilities exceeding $30 million. This effectively shuts out small and mid-sized exporters that have historically supplied global refiners. This is Beijing's rare earth playbook applied to silver. Remember how China weaponized rare earth exports? They're doing it again, but this time with a metal that's absolutely critical for solar panels, electric vehicles, electronics, semiconductors, and countless other industrial applications. The impact is already visible. Japan is reporting physical silver prices as high as $130 per ounce in local markets, while COMEX paper prices are trading around $71. That's an 83% premium on physical metal. This kind of disconnect signals one thing. The paper market is losing credibility, and buyers are desperate for actual physical silver. Elon Musk himself warned about this on December 28th, saying China's silver restrictions are not good for manufacturers who depend on silver for critical industrial processes. And he's right. Silver isn't like gold. You can't easily substitute it. Its electrical conductivity and thermal properties make it irreplaceable in many applications. China's move is strategic. They're securing domestic supply for their own solar industry and EV manufacturing while tightening global availability. This creates leverage, economic leverage, that can be used in trade negotiations, technology competition, and geopolitical positioning. Here's the reality that most people don't understand. The silver market has been running a deficit for 5 consecutive years. Let me break down the numbers. For 2025, global silver demand reached approximately 1.24 billion ounces, while total supply from mining and recycling came in at only 1.01 billion ounces. That's a deficit exceeding 200 million ounces in a single year. That shortage is equivalent to the entire annual output of the world's largest silver-producing country. But why can't supply just increase to meet demand? 3 reasons. First, 70% of silver is produced as a byproduct of copper, zinc, and lead mining. That means higher silver prices alone don't automatically trigger more silver production. Miners are making decisions based on base metal economics, not silver. You can't just mine more silver independently. Second, starting a new mine takes 8 to 12 years from discovery to production. Even if every mining company decided today to pursue silver projects aggressively, we wouldn't see meaningful new supply until the mid-2030s. Third, ore grades are declining globally. Miners are having to process more rock to extract the same amount of metal, which increases costs and energy consumption. Recycling helps, but it's limited. Silver recycling volumes have been relatively flat for years, and much of the silver used in electronics and solar panels is functionally unrecoverable or economically unviable to recycle. Now, let's talk about inventories. COMEX registered stocks have fallen dramatically from 2020 levels. The London Bullion Market Association vaults have also seen material declines. Shanghai inventories are reportedly near decade lows. This is happening across all major silver trading hubs simultaneously. When you combine structural deficits with inventory drawdowns, you create a powder keg situation. And that's exactly where we are right now. The Silver Institute projects that cumulative shortfalls could exceed 1.5 billion ounces by 2030, as renewable energy demand alone reaches 5-10 million ounces annually. Unlike gold, which is primarily a monetary metal and store of value, silver is fundamentally industrial. Approximately 50 to 60% of annual silver demand now comes from manufacturing and technology applications. And this demand is price inelastic, meaning manufacturers keep buying even as prices rise because there's no good alternative. Let's look at the key sectors. Solar panels. This is the fastest growing demand driver. Every solar panel uses silver paste for electrical conductivity. With global solar installations accelerating, this sector alone could consume 20% of total silver supply by 2030. China is the world's largest solar manufacturer, and their export restrictions make even more sense in this context. They're keeping silver to build their own solar infrastructure. Electric vehicles. Each EV uses significantly more silver than traditional combustion engine vehicles, in contacts, switches, and increasingly in battery management systems. As EV adoption accelerates globally, silver demand from automotive applications is projected to triple by 2030. Electronics and semiconductors, silver is in every smartphone, computer, appliance, and electronic device. With 5G rollout, Internet of Things expansion, and continued digitalization, this baseline demand remains robust. Medical applications. Silver has antimicrobial properties, making it critical for wound dressings, medical devices, and equipment. This sector might be smaller, but it's steady and growing. What makes this different from other commodity squeezes is that these industrial users cannot easily reduce consumption. A solar manufacturer can't just use 10% less silver. The panels won't work. An electronics company can't skip the silver contacts. The devices will fail. This creates persistent buying pressure regardless of price. When investment demand, from ETFs, coins, and bars, gets layered on top of industrial demand, the supply situation becomes critical. And that's exactly what's happening in early 2026. Now, we need to address the massive elephant in the room: the growing disconnect between paper silver prices and physical silver prices. Paper markets, like COMEX futures and London OTC trading, allow for massive leverage. You can control 100 ounces of silver with a fraction of the capital required to buy physical metal. This has worked fine when physical supply was abundant and delivery demands were modest. But that system is breaking down. Here's the problem. For every ounce of physical silver, there are potentially hundreds of ounces of paper claims. Various analysts estimate the paper-to-physical ratio anywhere from 101 to 501, though exact figures are debated. What's not debatable is that the system relies on the assumption that most paper holders will never demand physical delivery. But what happens when they do? We're finding out right now. On January 2nd, the CME Group, which operates COMEX, raised margin requirements for silver futures by 18% to $25,000 per contract. This forced immediate liquidation of leveraged positions, causing paper prices to drop, even as physical premiums exploded. Some analysts call this a bailout of the exchange, clearing members who couldn't handle the delivery obligations. Meanwhile, in Asia, physical silver premiums have gone parabolic. Reports from Japan show retail silver selling at 130 per ounce, while COMEX screens display 71. That's not a minor premium, that's a complete market dislocation. This disconnect reveals a fundamental truth. Paper markets manipulate prices downward through leverage and synthetic supply, but they can't create actual physical metal. When buyers demand real silver, the illusion breaks. We're seeing the same dynamics that played out in nickel markets in 2022, when the London Metal Exchange had to cancel trades and halt trading because physical delivery couldn't be fulfilled. The difference is that silver has both industrial necessity and investment appeal, making the squeeze potentially more severe and longer lasting. Let's talk about what's happening at the retail level, because this is where everyday investors are feeling the impact most acutely. American Silver Eagles, the most popular silver bullion coin in the world, are essentially sold out at major dealers. Those that remain in stock are carrying premiums of $6 to $10 over spot price, compared to normal premiums of $3 to $4. That is a 100% to 150% premium increase. The U.S. Mint itself has struggled to keep up with demand. Silver Eagle sales in December 2025 approached record levels, and January 2026 is tracking even higher. Dealers are reporting wait times of 4 to 6 weeks for popular products, and some are limiting purchases to ensure fair distribution. But it's not just Eagles. Canadian silver maples, Austrian philharmonics, and generic silver rounds are all experiencing similar shortages and premium expansion. The wholesale market, where dealers source their inventory, is reportedly even tighter, with some products simply unavailable at any price. Larger bars, 100-ounce bars and 1,000-ounce commercial bars, are also seeing premiums rise, though not as dramatically as smaller retail products. This suggests that fabrication and logistics are part of the bottleneck, not just raw silver availability. Online dealers are implementing dynamic pricing, where premiums adjust in real time based on inventory levels and wholesale costs. This means buyers checking prices in the morning might see different quotes by afternoon. And what's particularly interesting is the divergence between paper silver investment vehicles and physical silver. Silver ETFs, like SLV and PSLV, are trading close to net asset value with modest premiums, while physical metal commands massive premiums. This tells us that sophisticated investors are increasingly skeptical that ETF shares represent reliable claims on physical silver. Now let's look at where experts think this is headed. And I want to be clear, we're seeing some of the most bullish precious metals forecasts from major financial institutions that have ever been published. Goldman Sachs projects gold reaching $4,900 per ounce by December 2026, with silver benefiting from gold's rise and its own supply-demand fundamentals. Bank of America sees a clear path to $5,000 gold and projects silver averaging $56 in 2026, with peak prices potentially hitting $65. JP Morgan, yes, the same bank grabbing physical deliveries, forecasts gold pushing toward $5,000 per ounce by Q4 2026, with $6,000 possible longer term. They're particularly bullish on silver given industrial demand trends. Deutsche Bank estimates $3,900 per ounce support for gold in 2026 and notes elevated lease rates in silver, signaling ongoing physical scarcity. Citigroup recently revised its 2026 silver target to $110 per ounce, citing the ongoing supply deficit and what they call the China factor. Now, the really aggressive calls, Robert Kiyosaki, author of Rich Dad, Poor Dad, predicts silver could reach $200 by 2026. Some independent analysts suggest $100 silver is not only possible, but likely if physical delivery pressures continue. For context, 71% of retail investors in a recent Kitco poll expect gold to trade above $5,000 per ounce in 2026, while 57% expect silver above $100 per ounce. Here's what's driving these bullish outlooks. First, central banks continue buying gold at record rates, providing a floor under prices. Second, real interest rates, nominal rates minus inflation, are expected to decline as the Federal Reserve cuts rates, making non-yielding assets like gold and silver more attractive. Third, geopolitical uncertainty, from trade tensions to regional conflicts, drives safe haven demand. Fourth, and most importantly for silver, the structural supply deficit combined with industrial demand growth creates a fundamental mismatch that price must resolve. The question isn't whether silver goes higher. Most serious analysts agree it will. The question is how high and how fast. If physical delivery pressures continue forcing exchanges to raise margins and cash settle contracts, we could see parabolic moves that dwarf recent gains. So what should you do with this information? Let me give you some practical perspective, keeping in mind that I'm not a financial advisor, and this isn't investment advice, just market analysis. First, understand that we're in a structural repricing of silver, not just a speculative bubble. The fundamentals, supply deficit, industrial demand, inventory drawdowns, China export restrictions, are real and persistent. This isn't going to resolve quickly. Second, if you're investing in physical silver, expect to pay higher premiums and accept longer wait times. This is the cost of holding real metal versus paper claims. The premium you pay today might look small compared to future spot prices if the squeeze intensifies. Third, consider that the paper markets might not survive in their current form. If delivery pressures continue, COMEX and LBMA might be forced to move to cash settlement for most contracts, essentially admitting they can't source physical metal. This would accelerate the flight to physical. Fourth, diversification remains critical. Even if silver goes to $100 or $200, you shouldn't have your entire portfolio in one asset. Precious metals should be a component of a broader strategy. Fifth, be aware of scams and predatory pricing. In tight markets, unethical dealers inflate premiums beyond what's justified. Do your research, compare prices across multiple reputable dealers, and don't panic buy at any price. Sixth, think about allocation between gold and silver. Silver is more volatile, but potentially offers higher percentage gains. Gold is more stable and liquid. Most experts suggest a gold to silver ratio in your holdings that reflects your risk tolerance and investment timeline. Seventh, if you own silver mining stocks or ETFs, understand the difference between paper vehicles and physical metal. Mining stocks offer leverage to silver prices, but carry company-specific risks. ETFs are convenient, but might not give you true physical exposure if the system breaks down. Finally, stay informed. This situation is evolving rapidly. China's export policy might be adjusted. COMEX might change its delivery mechanisms. Industrial demand could shift. Monitoring these developments helps you make timely decisions. Let me bring this all together. We're witnessing a historic moment in precious metals markets. The combination of China's export restrictions, structural supply deficits, exploding industrial demand, inventory drawdowns, and COMEX delivery pressures is creating a perfect storm. The 17.2 million ounce silver raid in the first 48 hours of 2026 wasn't an isolated event. It was a symptom of deep systemic stress. Banks are fighting over physical metal because they know what's coming. JP Morgan grabbing 80% of deliveries isn't coincidence. It's strategic positioning ahead of what could be the greatest precious metals squeeze in modern history. When physical silver trades at $130 in Japan, while paper markets show $71, that's not just a premium, that's a warning. It's the market screaming that paper claims are losing credibility and physical metal is becoming scarce. China's January 1st export restrictions are the catalyst, but they're accelerating trends that were already in motion. The era of cheap, abundant silver is over. The market is being forced to price in reality. Silver is no longer a common metal. It's becoming genuinely rare relative to demand. Whether silver hits $100, $150, or $200 in 2026 depends on how quickly these pressures intensify and how exchanges respond. But the direction is clear. We're in the early stages of a repricing event that will redefine precious metals markets for the next decade. So what's your move? Are you positioned for what's coming, or are you still waiting on the sidelines? The banks aren't waiting. China isn't waiting. Industrial manufacturers aren't waiting. The question is, will you? That's it for today's deep dive into the silver market chaos of 2026. If you found this analysis valuable, smash that like button, subscribe to the channel for ongoing market updates, and drop a comment below telling me what you think about this situation. Are we heading for $100 silver, or is this another false alarm? I'll see you in the next video. Until then, stay informed, stay strategic, and protect your wealth.